York through the crisis from 07 to 11. And during that period of time, also having served on the congressionally appointed TARP oversight panel. So having a career, having started my career at the OCC and serving at Citi and TD and in-house legal and compliance, I feel I bring a pretty broad and I think objective perspective to this issue. I'm here to frame the discussion, keep us on track, and then we'll kick off with some questions and certainly save room for you to participate in the questions. You're going to hear directly from Sid Jajodia from Lending Club, our Chief Investment Officer, and also Usman Ahmed, Head of Global Policy at PayPal. So, two leading fintech companies. I'll let them introduce themselves when they come up and present. What I'd first like to do, though, is comment on the work of the Fed in this area, because it really was the Fed, to my knowledge, really was the first federal regulator to speak publicly about fintech, recognizing the benefits to consumers, to small businesses, to community banks, and the financial system more broadly, but also recognizing the challenges. I was there over 2 years ago when Governor Brainerd really framed the Fed's perspective on this, and I think the other banking agencies have followed her lead. But as the Fed, they had to be supported by data. And I think one aspect that you're getting to fully appreciate over the last 2 days, and maybe something that is not fully appreciated by a broader set of policymakers, is the volume of the data that is out there provided by particular firms and the level of transparency. In our case, as a marketplace, we decided early on that it was critical, if we were to be a marketplace with both retail and institutional investors, that transparency of the data was key. And I think that's going to be a big part of Sid's presentation. We also welcome the work of Fed researchers at the various reserve banks, as well as the board, and also of the academics that I know have been working in this area, and many in this room who even approached me after with particular ideas for research. This area and use of data has created an entire ecosystem of other entrepreneurs who are analyzing this data to provide additional analysis for investors. Now, when we talk about fintech, it's really often described as an unbundling of financial services traditionally provided by traditional banks. The best visual that I have seen in describing this unbundling is a visual that starts with Wells Fargo's homepage. And you see here the various financial services provided by Wells on the deposit, lending, and wealth management side. You then overlay this with the various entrepreneurs and platforms that have been developing, and you see something like this. This continues to grow. Many of you may have seen this already. There are several versions that have been adapting, and it's getting smaller and smaller in terms of the names. I saw one that I couldn't even put up there because it would be too difficult to see. But I think it's just a dramatic visual of how this unbundling is developing. So what we want to do today is really just focus on the challenges, the benefits, the expansion of using fintech to expand credit access and particularly financial inclusion. I've highlighted 3 reasons why I think this is happening with respect to the expansion on financial inclusion. They're pretty obvious: reducing operating costs and providing lower costs and rates to more borrowers, improving the credit decisioning and enhancing the consumer experience. And then third, which interests me the most here, is how these platforms are filling gaps in the market. In our case, at Lending Club, we have 3 principal products: consumer installment loans. Most people are borrowing to pay off a higher price credit card, auto, refis, and small business loans. And in each of these, we are filling a market gap, a business model constraint, or a channel conflict. And when you think about it on our installment lending side, there's a real disincentive for large commercial banks in the credit card business to cannibalize their credit card offerings. And therefore are not offering installment loans to refinance those credit cards. On the small business side, this is another underserved segment because the large commercial banks, as you will hear, have really pulled back dramatically on lending to small businesses, either because of the regulatory constraints on capital to small business, but primarily because of the cost of underwriting small dollar loans under $100,000 or $250,000 even. And then in the auto loan area, of course, large banks could offer refis for auto loans, but there's a disincentive they don't want, or reluctant to disturb the relationships they have with auto dealers on the indirect auto lending. So these are just three examples. I really like now, we're going to turn it over to Sid and then to Usman to go into really much deeper levels about the businesses themselves, but also the aspects of filling market gaps and expansion of financial inclusion. So let's lead off with Sid.
Thank you. Thank you.
Let's get back here. How do we get back here? Okay, and then you just flip that.
Just click on it.
There you go, and then use this. Okay.
Thank you. Good morning, everybody. I'm Sid Jajodia. As Richard said, I'm with Lending Club. I'm the Chief Investment Officer, been there for 4 years now. Prior to that was at Capital One for 13 years. Grew up at Cap One as on the risk side, but really using data and analytics to make good strategic decisions in financial services. So that's who I am. In terms of who Lending Club is or what the company does, I want to take maybe a couple of minutes just to frame the business model and who we are before we dive into who the borrowers are, how we help them, how we use data, and some of the questions that I've seen come up over the last day out here. So we're headquartered in San Francisco. We were founded in 2006, but we really came into existence for the most part during the last great financial recession. So 2008, 2009 were formative years for Lending Club and our business model. We're a public company, one of only a few in the fintech space who are public, and therefore we have all the scrutiny that public markets bring to us as a company. But what that also does is it brings a pretty strong balance sheet. We have close to $800 million of cash on our balance sheet. We're the largest marketplace lender and the largest provider of personal loans in the US. That always strikes people as a bit of a surprise. When they think about unsecured lending, they think about the largest banks, the Cap Ones, the Amex, Discovers in the country. But when it comes to unsecured installment lending, Lending Club is the largest lender in the country. A headcount of 1,600 people. Just as an interesting side note, when I was interviewing 4 years ago, the company was 180 people. So we've grown 9 times during the last 4 years, just in the number of people we've employed, and that's really just a parallel to how fast the business has grown and the number of customers we've served over that time. And that brings me to $28 billion lent to consumers and small businesses over the last 10 years. We're doing annually about 8 to 9 billion right now. We expect to continue to grow. We see a very big addressable market ahead of us. So while 8 billion a year sounds big relative to where we started, we think the market we're going after is in the trillions of dollars. Total unsecured consumer debt is $1 trillion in the United States. When you add in secured consumer debt, including auto and mortgages, it's $13 trillion. So there's a lot of runway ahead of us. We think our business model adapts to other product classes, not just consumer loans, and that's our objective. So Richard talked about auto and small business lending as other products we've launched, but we continue to anticipate that we'll get into other product classes as we go forward. So what's the business model itself? We're a marketplace. Like any marketplace, we have buyers and sellers. So the sellers here are people who have capital, who are essentially providing the capital, and the buyers here are people who are borrowing, who need the capital. And the exchange is something that the marketplace is facilitating. The service we provide to the two sides of the market is we're acquiring good creditworthy borrowers, we're doing the diligence, we're doing the underwriting, we're doing the pricing. In exchange, we charge the borrower a fee for bringing them to a platform and providing fair price. And the investor gets these loans that they otherwise would have to set up an operation to do themselves. But in the process, as we service the loans for them, we charge them a fee to service the loans on an ongoing basis. So Lending Club has historically made its money through charging a fee to both sides of the market, but really facilitating a market where people who need capital and the people who provide capital. More recently, our role has evolved, and part of it that is feedback from the market. Part of it is just a general evolution of the business model itself. Because we're talking about financial transactions, we get the question a lot. So what about skin in the game? Do you have skin in the game? So in the last year and a half, we've started to take risk on our own balance sheet. One of the new class of investors we have developed is through securitization. So yesterday we closed on our second self-sponsored securitization. And as a part of that securitization, as a result of Dodd-Frank, as well as a result of expectations from our investors, we hold 5% of the risk on our own balance sheet. And we'll continue to use our balance sheet in more strategic ways to test into new products, to test into new segments, and continue to find ways of delivering value to both borrowers and investors. So we talked about lowering costs. How do we lower cost? When you think about the traditional model, banks, these are the drivers of their cost. And analyzing bank P&Ls, you find that banks spend about 5 to 7% of their portfolio asset size every year in terms of just cost of running that business. And that's really driven by branch infrastructure, reserve and capital requirements, and then just the nature of running a lending business, customer acquisition, underwriting, origination, and servicing. Lending Club doesn't have two of those costs, the reserve requirements as well as the branch infrastructure. We run a completely online platform. We don't have branches on the corner of streets or neighborhoods. And we don't have reserve requirements because we're not using government guaranteed deposits. To the extent that we're using our balance sheet, it's either equity or the use of a warehouse facility that's not close to being as leveraged as a typical bank would be. But even for the other costs, customer acquisition, underwriting, origination, and servicing, we're able to use data and technology to compress that cost such that for the portfolio that we manage, our expense base is about 2%. So that gap relative to the 5 to 7% of expense that the traditional model faces and the 2% that Lending Club incurs, that benefit can then be redistributed through lower rates for borrowers and better yields for investors. So who are the borrowers? Who are we actually helping? We've talked about financial inclusion a little bit, and I'll touch on that a little bit more. But these are borrowers who, while they are mainstream in terms of demographic, mainstream in terms of FICO, you look at their average FICO, it's 700, 17 years of credit history. On average, they have 10 trade lines on the credit report. So these aren't people who are not being banked in any way. These aren't people who, if they walked into a bank, couldn't get a loan. They can. They're coming to us because they find the process to be a lot more convenient, but also that we're able to deliver the product at a cheaper price. I talked about the lower cost of operation. We can deliver a lower cost unsecured lending product to these borrowers. And that's why 80% of the use case here is either debt consolidation or refinancing existing debt. Our borrowers tell us why they want the money. 80% of the time, it's to refinance existing debt or consolidate existing debt. And on average, we've saved borrowers a little less than 5% relative to their current cost of borrowing on the credit card that they're refinancing. And this is, when you look at the loan size, it's about $14,000. These are small ticket loans, but they tie very closely to what the average revolving balance the borrower who's doing that refinance is carrying on their credit cards. Credit cards are a great way of making payments. You go in, you swipe your card, you made your payment, you don't need to carry cash. However, it's not a great vehicle to carry debt. You take 30 years to pay off the debt if you keep making minimum monthly payments. The debt can get repriced over time, or the access to debt can get repriced over time. That changed a little bit with the Card Act, but the relative cost of carrying that debt is very different than if you had a self-amortizing product where in 3 years or 5 years, the lender's exposure to the borrower, the credit exposure went down, right? That's another reason why the price of an unsecured installment loan is different than one for a credit card, and why banks, given how profitable a credit card product is for their P&Ls, cannot cannibalize their own book by doing installment loans. On the small business side, it's really a function of access to credit. The typical small business has a need for a loan that's $100,000 to $200,000 or less when it comes to unsecured loans. If you're buying a piece of land or you're investing in equipment, you can usually find secured debt at a reasonable rate. There are providers for that. But when it comes to unsecured financing or blanket UCC-based financing, the cost of underwriting $100,000 or $200,000 or $300,000 loan for a bank is the same as for a middle market loan, because their processes tend to be very high touch. Let me ask for 3 years of financial statement. Let me ask for personal statements from the owner. The depth of underwriting, because of how they approach the underwriting, just the revenue model doesn't match the cost model. The way to deliver small ticket, small business loan has to be the use of data and the use of technology to reduce that cost, reduce that friction in the process to make this affordable. Because of the cost in the model, what we've seen is banks, when you look at the commercial lending book, so non-consumer lending, for banks, it used to be small business lending was 40% of the commercial lending book. And that was 15 years ago, 20 years ago. Today, it's down to 15% of the commercial lending book is small ticket, small lending. They've just pulled back. Part of it is also small community banks were the drivers of C&I lending in their localities. The number of community banks has gone down as well. So in terms of small businesses, small ticket lending, they're just fundamentally underserved. And we're providing sort of access to that credit using data and technology, bringing the price down to a fair price, because their alternatives otherwise are daily debit, cash advance products, which is the equivalent of a payday lending product in the business lending space. And that's why banks partner with us. So, this theme of, are fintechs disrupting banks, or are they an evolution of how banking has been done? We strongly believe it's an evolution. There's a lot of opportunities for banks to partner with us. We have over 40 banks on our platform buying loans or partnering with us in different capacities. And that number continues to grow. That number was 0 5 years ago. We're up to close to 4 dozen. And the driver of that is really, when you think about our business model as a marketplace, we have a very diversified funding base. 45% of our funding in the last quarter, in the second quarter, came from banks. When you think about banks' risk appetite, it is limited by what their cost of capital is, what their regulatory sort of oversight requirements are, as well as so from a relative reserve requirement, capital treatment, what the ROEs for leveraging up their bank balances are. There are other participants on our platform, like hedge funds, asset managers, pensions, endowments, as well as self-directed individuals, high net worth individuals coming through asset managers. Their risk appetite is much broader than the banks. As a result, we can say yes to a lot more borrowers than a bank themselves could say. And so for a bank to partner with us, they can send their own customer base to our platform and serve more of their customers' needs from a borrowing standpoint without necessarily taking on the risk. So we're seeing co-branded marketing partnerships where banks are sending their own checking and other deposit customers who want a loan, who they otherwise don't have either the data and the technology to serve, or frankly, don't have the risk appetite to serve as deeply as we could if that customer came to our site. And then the bank can choose to invest in the loans that fits their risk appetite without necessarily going deeper into the risk spectrum. So it's a win-win for both sides. If you think about the smaller banks, the community banks, For them, access to unsecured consumer credit has dwindled. Unsecured consumer credit is highly concentrated in the hands of 6 to 7 banks. I think it's 93 or 94% of unsecured consumer credit sits with a handful of banks. And the reason for that is it's a segment of business where you need to have scale, national scale, you need to have technology capabilities, and you need to have very strong data capabilities. The small banks do not have any of those three. They don't have a national footprint, they don't have the technology budget, and they don't have the data and data science capabilities associated with analyzing large pools of data to make good, strong risk decisions and being able to serve their customers. As a result, only the best credit card players have consolidated unsecured lending. What a platform like ours provides is an opportunity to level that playing field. For a smaller bank, they can come partner with a lending club and have access to a consumer unsecured asset class on their balance sheet in a way they otherwise themselves could not. And you see that in the sense of the size of banks on our platform. We have banks that are few branches all the way to 100 billion plus asset bank on the platform buying loans. For each of them, we serve a different purpose and a different need. For the customers themselves, it's access to credit at a fair price, and it's a very convenient process. They come to a website. It's a matter of a couple of minutes. They fill out an application, and in a couple of days, they have money in their account. Very streamlined process, and allows them to avoid higher cost alternatives to the extent that their bank could not serve them directly. So how do we do that? I talked about data and technology, and this is really just a fancy visual of saying we have a lot of proprietary models that we have built, and we've been able to build these models because of the amount of lending we've done. We have data on 2 million loans that we've made ourselves, $28 billion lent. We can acquire data from credit bureaus to supplement over and above the customer data that we have ourselves. And we have the technology and the capability from a data science standpoint to build better models than off-the-shelf tools. Our models are significantly better than FICO. I know the paper that the Philadelphia Fed produced talked about how correlation to FICO had gone down over time as they analyzed the lending club data, going back to our early vintages to our more recent vintages, and I'll talk on that in a second. But when it comes down to what kind of data we use a mix of traditional and non-traditional data. So when you think about traditional data, it's what is the credit situation of the borrower today, and all of that comes from the credit history of the borrower. You can go to a credit report, you can see what they are like today, what has been their propensity to pay debt or manage debt in the past. The borrower tells us what their income is, we can verify that. That is traditional data that any lender would otherwise have access to. There are some non-traditional data. We live in an entirely online world. The consumer coming to us is not coming to a branch to close a transaction. There isn't a handshake or a wet signature. This is an anonymous borrower on the other side of an internet connection. It's critical for our platform to figure out whether or not the borrower is who they say they are. And for that, we've built over time technology to identify fraud risk. And here, a lot of online footprint data is critical. And when I say online footprint data, for a lot of people, the first thing you think of is Facebook, Twitter. That's not what we use. We do not use social media data because we feel there are privacy implications of looking at someone's Facebook profile to make a risk decision or a lending decision. There's also fair lending concerns. You do not want to make subjective decisions by pulling someone's profile, looking at words that they're using. It really comes down to data that helps us identify the identity of the borrower. Are they who they say they are? So everything from if the borrower is applying using an internet connection, which is the only way to apply on our website, you have to come to the website and apply. We can capture the IP address, we can geocode that IP address, compare to the stated address on the application. So, for example, if you say you live in Boston on the application, but the application is coming from an IP address in Florida or Africa or some other part of the world, our system would automatically flag that and send that to a fraud queue to review. So that's just one example, but we use a lot of data like that to instantly figure out, is this application a suspicious application? Do we need to do additional identity verification? Do we need to have more of an interview type process on the phone with the borrower to figure out or verify pieces of information, or frankly, ask the borrower for documentation? So there are pieces like that that go into it. And then critically, analyzing borrower behavior. So anytime you give borrower a choice, when a borrower makes that choice, the choice reflects risk. And that is not available on a credit bureau. You can't go to an Equifax, Experian, or TransUnion and say, well, if the borrower takes a 3-year loan or a 5-year loan, what's the risk difference that I should expect based on this borrower's FICO? That only comes from learning, capturing the data, and analyzing the data. Same thing, if a borrower's telling me they want a certain dollar of loan, but we're only able to offer something less and the borrower takes it, does that choice reflect something more about the borrower's risk that we're not aware of? The channel a borrower comes from, someone who's searching on Google versus someone who is coming through a direct mail solicitation. One is credit-seeking behavior, credit hunger. The other, the borrower wasn't looking for credit. We were soliciting them for credit. How much does that drive in terms of difference in performance? And using all of that information to make better risk decisions and, frankly, better pricing of that risk is critical to be able to deliver the best price to the best borrower at any given point in time. Those are just a couple of examples of the kinds of data. When we talk about alternative data outside of what FICO or the credit bureau can provide, it's not data that violates privacy. It's not data that is a proxy for prohibited classes. We're very careful around it. We have strong principles, whether it's ECOA, FCRA. We want to make sure we're following all the same consumer regs that any bank would need to follow. But more importantly, look at data that the consumer has control over, that's driven by the consumer's behavior, that reflects on their risk, and that we can show that transparently back to the borrower to the extent that we cannot help the borrower. So let's talk about how that shows up in performance. So when Lending Club was started back in 07, thank you. When we started back in 07, we were clearly more reliant on off-the-shelf tools like FICO, so higher correlation between how our assessment of borrower risk was relative to what FICO would have maybe assessed the risk. As time has gone and or passed, and we've built up this own proprietary data set, and we've mined that data set, and we've become the largest installment loan lender, we're better able to mine that data to build better tools and models to assess borrower risk. And as a result, correlation with FICO has gone down. The chart on the right, I want to spend maybe a couple of minutes on because I think that's interesting as we talk about sort of this idea that FICO isn't as powerful. FICO is really a tool that's designed to be useful for many purposes. For splitting risk at application stage, for splitting risk in your portfolio as you're managing a portfolio, whether it's auto, mortgage, credit card, it's really sort of a tool built to split risk for multiple use cases. Anytime you're building a tool for something that's a more custom application, with data, a statistician should be able to build a better model. But with more data and the kind of experience and the kind of data we've captured, we're able to do it one better. And what you see here is the chart on the right, just to orient you, the x-axis are true deciles, so splitting the population into 10% deciles. If I take the yellow line, which is FICO, the best 10% within our application pool, if I use FICO as the risk splitter, the best 10% would have had about a 5% default rate. Using our model, the best 10% of the population the model identifies has half the risk, a risk of 2.5%. What that means is, for these borrowers, we can give a much better price or much better interest rate than had we used FICO alone, right? On the other end of the spectrum, if we had looked at the worst 10% in terms of risk, FICO would have given a population with a 15 or a 16% default rate, right? Whereas our model identifies a population, again, which is 25% risk. So we can say, okay, these are borrowers we can no longer serve, or to the extent we need to serve them, they need to be priced differently had we been using just FICO alone. So just the risk discriminatory power of the model, the ability to slope risk and slot people into buckets appropriate to their risk, more homogeneous populations from a risk standpoint, allows us to better serve the borrower with a better price and then better serve the investor by managing the risk and pricing the risk most appropriately. So in terms of the impact of all of that is, the paper from the Philly Fed, Jalapa's paper, very clearly laid out the benefits from that power over FICO. The model's ability to rank order risk over FICO is we can give loans to people with lower FICOs who our model deems to be lower risk, and therefore give them better products than the market otherwise would have given them. At the same time, as consumer preferences have changed and they've gone to online platforms like we do for everything, our shopping behavior as a consumer has changed. We have been able to serve customers through better, more convenient ways of delivering the product. And then in markets where we're seeing higher concentration in terms of banks, because other banks are pulling out, we've been able to serve borrowers in ways that the local bank or the concentrated bank in that market is not able to serve, right? And we've been able to become a platform of choice for those borrowers, for those consumers to have access to their product. So greater financial inclusion, better pricing, as well as more convenient, but a helpful tool for banks to partner with as they evolve to serve their own customers.
I just wanted to begin in the same way Richard did by thanking the Philly Fed for hosting this conference and for driving thought leadership and research in this space. I've presented at a few conferences in the past, and I really appreciate the academic perspective and the rigor that folks go through. And I originally came to this thinking to present a paper, but then it kind of became this keynote speech, so a little bit broader landscape. But if anybody has questions or wants to chat about any of the papers that I kind of briefly go through in this afterwards, or get the sites, would be more than happy to do that. And I'm going to really build on what Sid talked about and use pretty much the exact same term he did, which is evolution. Which is how we really see what's happening in the fintech ecosystem. And I present that in a historical perspective by saying technology has been a part of the financial services landscape for a very long time. If you think of, I don't know what's happening with that slide. Credit cards or ATMs, online payments, these were all technology solutions, often by non-banks, ATMs by IBM, credit cards by a retailer. Online payments, I guess PayPal was a big innovator in that space, and then you have today with fintech. But I do want to kind of elicit, and I hope the rest of the slides don't have this glitch, but I do want to elicit some of the differences that modern or today's fintech has vis-a-vis the other more historical forms of fintech. No, it's doing it still. So 4 things I want to call out with this slide. First is startups. So you see $24.7 billion invested in fintech startups in 2016. The year before that, I believe it was $14 billion. So kind of this massive increase in investment in startups. And that's a very unique kind of aspect to this fintech space, today's fintech versus maybe 20 years ago when it was 1 or 2 pretty large technology companies that were doing stuff in this space. As Sid mentioned, there's only a couple of fintechs that are actually public. The vast majority of them are quite small. And you see on the second number that there are 2,000 of them. So quite a large number of relatively small fintechs playing in this space. The second number also elicits my second point, which is that this is a very global phenomenon. There are kind of developments occurring in emerging markets, and I think the one that often comes to people's minds is mobile money in Africa, that are actually providing learnings in developed markets. So that's a very unique kind of aspect to the modern fintech that maybe wasn't there in the 70s or 90s. The third is, and Sid talked about this as well, the kind of the speed and the scale is the way I would describe it. So fintechs are really partnering with banks, as we heard in the earlier presentation, for the scale that they provide, the customer relationships, the trust, the regulatory scrutiny that they're subject to. And fintechs can partner with them. So for example, PayPal has partnered with 18, not just banks, but large companies in the past 18 months. So that really provides this speed and scale of this technology that wasn't there in the 50s and 70s, 90s. Fourth would be mobile. Mobile is absolutely central to all of the aspects that you see going on around that circle, is that mobile technology enables a fintech to really play in each of these spaces where it traditionally was very difficult to get the data on the customer, to be able to reach the customer, to be able to verify the customer. Now with mobile, you really have this ability to impact each segment of the financial services ecosystem. So those are four really big trends that we see that are rather different in this fintech evolution vis-a-vis previous ones. But at PayPal, fintech is a cool word, and technology is certainly what we're about as a company. But if you hear our CEO ever speak about fintech and PayPal more generally, he doesn't talk as much about technology. He talks about our mission and what our purpose is as a company. And our purpose, according to our CEO, is to democratize financial services. So to use technology as a tool to actually achieve a greater purpose. And we've talked a lot about financial inclusion, but PayPal really talks more about achieving financial health. So not just access, and certainly in the US, access may not be the fundamental problem. We have 8 million unbanked, we have 22 million additional underbanked. The problem is not that they can't go and physically get a bank account. There are structural problems that make it so that they choose not to get one. And so that's why we want to build, in partnership, kind of solutions that will move folks along this path so that not only do they access an account, but they actually use it, they participate in the system, that they actually benefit themselves as a result of participating in the system. And our end goal is this concept of financial health, where people, the CFSI defines it as kind of the ability to have stability and to be able to pursue opportunities. That's really what we're trying to do, both for consumers and small businesses through the products that we operate. So let me give you a bunch of examples, and here's where I'll just briefly be running through a bunch of papers that have a lot of deep economic analysis that I would imagine an audience like this would be very interested in, but unfortunately due to time, we're not going to be able to go into the details of each, but after would love to kind of share more. So these are 5 concepts that I want to call out as to what fintech is doing for people's financial health or their socioeconomic circumstances. The first we heard from Lending Club, and you saw it in the Philly Fed paper, is this concept of increasing access or filling a gap. And so we did a paper with Torsten Beck at Cass Business School looking at a product that we have for small business lending called PayPal Working Capital. We looked at 60,000 loans between 2014 and 2015. And we overlaid the zip codes of those loans on top of FDIC data on where banks in the United States had closed since the financial crisis. And what we were able to see was that there was actually a pretty strong correlation, and that 25% of the PayPal Working Capital loans were actually going to counties where 10 or more banks had shut down, and that was only 3% of counties. So kind of massively over-indexing to these places where, as we heard, community banks that used to be the ones providing these smaller loans had closed their doors. Secondly, due to our data, we were able to understand their income levels and understand that we, again, disproportionately were able to serve low and moderate income businesses. The average that the Federal Reserve Bank and Census Bureau report is about 21% of bank loans go to low and moderate income communities, and in ours we found about 35%. And the third big problem that Federal Reserve Bank data calls out with traditional lending is smaller firms that are 5 years or younger. There's a great study by the New York Fed that looks at businesses that are 5 years or older have almost 90% chance of getting approved for a lending application, and those that are 5 years or younger, it's about 32%. So 61% of our businesses were 5 years or younger in this cohort, kind of demonstrating again that we're over-indexing to this community that had traditionally had a lot of trouble accessing finance. So that's the first kind of call out that I want to raise in terms of what the research is showing, is that fintech is filling this gap, is providing this access. The second one is choice, and here's one I'd love to do more research on, but it's kind of a fundamental shift in our company's value proposition. Is we want to empower choice, and we think that choice is the ultimate kind of benefit to a consumer, is to enable them to choose exactly what they want to do. And that's part of our partnership strategy, is we've enabled people, whatever kind of payment mechanism you want to use, whoever you want to pay it to, and whatever kind of merchant solution that business wants to use, we want to be a platform to enable that choice. And At a high level, we understand from economic perspective that increasing choice is generally a good thing. Visa has probably done the most interesting research on this, I'll call out. And what they did was they looked at the choice benefits from people being able to shop online versus just shopping in their locality. And they have a fascinating paper that I think is about to come out, but if you Google Stanford and Visa, you'll see this paper, I think it's called Understanding the Benefits of E-Commerce. And it shows that in 2014, they estimate that a household saved about $1,250 from online purchases that traditionally 20 years ago they would have had to make locally. So that's a pretty large scale savings that's coming from giving people the ability to choose from different businesses, different products, different services. Expanding that choice architecture on the buying end actually ends up increasing a lot of savings. And what I'd like to look to is expanding people's choices in terms of their funding mechanisms or their payment mechanisms, I would imagine also has a pretty strong effect on their overall consumer welfare. So that's two. Third is small businesses and their ability to grow, which is certainly a major policy concern for people in America and people around the world. We did some very interesting research looking at about 30,000 small businesses in the US. We did a robustness check using 100,000. We have about 15 million merchants around the world, so just a small sliver of them. But what we wanted to do was look at the trends in US small business growth, as well as their ability to export. And so Commerce Data has shown that only about 5% of businesses actually export in the United States. When we looked at the PayPal data, it was close to 80% were actually engaging in exporting. And what that meant was that they were seeing a premium. So in 2015, this is not government data, it was a private sector company that found that US small businesses grew at about 7.9%, 2015 to 2016. And they also found that when they just looked at the exporters in that segment, they saw a premium, so they grew at 9% year over year. And there's a lot of research that shows that exporter premium is something like 10 or 15%. So what we did when we looked at the PayPal small businesses was we saw in 2015 to 2016, they grew at about 22.9%, so massively outpacing the typical kind of business. And again, that's the online experience, that's the ability to reach 200 million customers around the world. But the exporters, most interestingly, grew at 32.8%. So the online environment provides the small business this ability to not just access 300 million people in the US market, or more specifically in the past, maybe whoever was in your local community and would walk by your store. Now you have potentially 4 billion or so people that are connected to the internet that can access whatever it is that you're trying to offer. So a really interesting kind of dynamic in this, and that paper is called Democratizing Globalization, if anybody wants to have a look at it. Next, lowering the costs. So we've talked about payments and kind of helping people to have more choice, but one of the other implications of digitizing payments is simply lowering the costs. So the World Bank has done a ton of research on remittances because it's a major cost source for usually low and moderate income people, sending money also to very, very low and moderate income people in the developing world. And the UN actually has a sustainable development goal of reaching 3% global remittances by 2030. When we looked at World Bank data, and we worked with Dilip Ratha at the World Bank and actually published something on the World Bank website about our findings, when we compared that to PayPal and the product that we have in our ecosystem that works on remittances called Zoom, we found that we were about half the cost of the traditional average and that we were about 3.9%. And you should note that this finding actually includes a lot of cash out. So because a lot of the developing world still doesn't have strong banking ecosystem, people are still often taking cash out of the ecosystem. But when we look at products we have which are called direct to bank or bill pay, where on the other side of the transaction in Pakistan or in Guatemala, the person actually is having a bill paid for them or the money is going directly to their bank, it's below 3% cost. So we would already, if we digitized remittances, we would already achieve that sustainable development goal. So a pretty realistic and important kind of implication here from fintech that I know in the US we have many, many large concerns. This is a $600 billion marketplace of remittances globally, and it seems to be increasing, unfortunately, because of refugee crises and other reasons. So solving this problem actually has tremendous implications, and particularly for low and moderate income people, both in the US and around the world. So that's four. I hope you got enough energy for one more. And that's kind of wealth management. And we heard an academic presentation on Betterment and Wealthfront. There's a fintech startup called Acorns. And what they do is very interesting to listen to the first presentation today and hear about kind of the challenges in keeping millennials, particularly younger people, kind of attuned to saving. That's been a big problem. I think research shows that about over 50% of people don't have enough money to cover a $1,000 expense. And it's actually worse amongst millennials. They don't save. And so this product is really designed to help with that problem. And what it does is, it's an app, you download it, you link it with your debit card, and every time you make a swipe payment or you pay something online, it takes the change and it actually invests it in an exchange-traded fund. So it automates the process of saving, making it a lot easier. And one of the reasons why we heard people will stop actively engaging in the product because they just don't have the time or they don't see the benefit. This automates that process, makes it incredibly easy. So if this was a $197 transaction with 20 cents, it would invest 80 cents in the exchange traded fund and basically build up your wealth and savings over time. And another really cool thing that they're innovating with is they're partnering with like Airbnb and Uber and a lot of these companies that a lot of younger people use, and every time a consumer will choose to use one of those solutions, they'll invest a little bit of money. Uber will, because they're getting a customer lead, so they're willing to pay into somebody's savings account. And so those are the kinds of solutions that I think will really drive kind of more savings, more healthy behavior that we were hearing about from the first presentation, is really making it incredibly easy, making it incredibly simple to kind of engage in these healthy behaviors. So that's it for me on the economic side. One last point about how can we actually unlock more impact together, both in the academic community, the government, as well as the private sector. And we often hear 4 questions around this space that really drive our thinking on fintech and the future of fintech. One is around financial services, purely financial services related questions, and we heard about the challenge in identifying these consumers, figuring out who they are, appropriately combating anti-money laundering, non-bank regulation, non-bank oversight, major issue that we're very interested in working on. Secondly is security and privacy related concerns, and obviously these are top of mind right now in the financial services ecosystem. How can we better secure consumers, small businesses, those that are using the system, to make sure that they have trust in these solutions, because they obviously have strong financial health benefits, but what are we doing to kind of incentivize and ensure trust? Third is consumer protection. How do we make sure that there's transparency, disclosures, redress in the system? And lastly is the kind of overall regulatory system, and how do we make sure it works together? I'm out of time, but the last thing I'll say is we see a lot of opportunities and challenges and areas for public and private to collaborate on, making sure that people understand the benefits of these technologies, working on savings schemes that the government can be involved in, particularly for low and moderate income people, security, internet access. A lot of the solutions, all the solutions we have are basically predicated on there being internet access. So if people don't have that, that doesn't enable them to use some of these beneficial technologies. So those are areas where we'd love to kind of explore more collaborative opportunities with government entities, nonprofits, academics, and others. So that's it. Thanks.
We have time for 1 or 2 questions.
Thank you. Neil Desai from MasterCard. Question for Sid. Either when it was early days in the US or maybe now in developed parts of the world, what were some of the challenges that Lending Club faced with either acquiring consumers, meaning driving them to your app or website, and then on the bank side, developing and establishing that network?
So Lending Club today is only in the U.S., so I'll frame the question only or answer the question only with respect to the U.S. Anytime you're starting out a new service or a new, launching a new company, a big question is, how do you drive awareness, right? You can't run television advertising or anything else because you don't have the budget for it. So it's a question of, you can achieve it a couple of different ways. You can either do marketing and build on your business over time. The other is the product goes viral and people opt in themselves, right? Every product, some products are more likely to have those kinds of sort of viral network effects. Others take more time to build. On our consumer side, we've had 20 million or so borrowers come to our platform to explore our products in terms of actually registering on the site and starting an application at some point in time or the other. That's a pretty sizable part of the US population at this point in time. But it's taken us 10 years to get there. Early on, we started as a Facebook page as the easiest way to get in front of people. It is a page on Facebook, but as the company grew, we've used a multi-channel strategy. So we've done everything from the more traditional pre-approved direct mail to SEO, SEM, partnerships with companies like Mint, Credit Karma, places where a borrower is more likely to go to manage personal finances and then be an option or a solution for them at those points. I think point of sale is an area that we'll continue to look at and see how we can be more present at point of sale when someone's buying something. How do you be there as a solution? So that continues to be the challenge. I think it's even a bigger challenge on the small business side than it is on the consumer side. Business owners tend to be running from 6 a.m. in the morning till 11 at night, running their business. They don't have time to sort of shop around, read the news. Their tendency is to go to their financial provider of choice, which is where they go to sort of put their cash in and their checks in, which is their local bank. Awareness of all of these other options is low. How do you get in front of the business owner? How do you make the business owner aware without spending money that doesn't have the right return on investment? I think that continues to be one of the bigger challenges. Is the consumer has evolved to the point where consumer behavior is very unbundled. No consumer has their mortgage, their credit card, their checking account, their auto loan all at the same place. As a consumer, we just used to looking at natural places to find these products. Business owners still tend to be very concentrated at their local banking institutions. And seeing that unbundling and trying to drive that kind of a shopping behavior continues to remain one of the challenges that all fintechs continue to face. Right?
Thank you. I think we need to take a break now. Little coffee break for 10 minutes. The bank's president will be speaking at 11 o'clock, and I want to be sure that we keep on his schedule. So let's take a break and come back in 10 minutes. Thank you all. Oh my God, my back is killing me. Oh.
Terrific. Yeah.
Thank you very much. I really, yes, I like the talk. I'm just sorry that we couldn't get the paper in, but it was so late.
I totally understand. I didn't mean it that way.
I mean, I could talk to Jalapa now. No. We can certainly. No. What do I do? I just need to figure that out. Take whatever you need.
Be careful, Sid. Okay.
Yo, it really is. Yeah.
Thank you.
It's not free, but okay. We'll have to see like next Yeah.
Good morning, everyone. My name is Dick Herring. I'm a longstanding colleague of Pat's, and I have the easy job today of introducing someone who literally needs no introduction. Nonetheless, I'll provide one. I think everybody is familiar with the highlights of Pat's career. He has 4 degrees from Penn, spanning economics and engineering. He was one of the youngest chaired professors at the university. He was a White House fellow. He chaired his department, edited the leading journal in his field. He became a transformative Wharton dean, then president of the University of Delaware, and now, of course, he's the 11th president of the Philadelphia Federal Reserve Bank. I had dinner with Pat last night, and I commented that I was not at all surprised he was a president, but I'd always thought he would be president of a railroad. And the reason is, it's not entirely idle. His first chair was as a transportation professor. He actually holds some patents for running railways without human intervention, which would have saved a lot of death and suffering if they had been implemented. And he really was passionate about railroads. He pointed out, however, that I was sort of one of the reasons that he shifted his interest to finance. And the reason is that Pat was enormously helpful to me in putting together a grant to the Sloan Foundation to study the financial services industry. He was not only very cooperative, but imaginative. He got things in on time. And he led the key initiative, which was looking at productivity in banking. And it captured a wide amount of attention because you actually measured productivity in a way that people hadn't done before. The number of different screens people had to look at to make a consumer loan. A variety of things that were quite sensible, but really hadn't been thought through and had a real impact on the industry. Well, Pat was a transformative dean at Wharton. One of his initiatives that had particular impact was a very clever initiative to deal with a competitor to the north in the Charles River who sort of dominated the business review space. And Pat's view was that it was sort of hopeless to go into the print world, but that we could be more clever and deploy technology. And so it's sort of fitting at a FinTech conference that Pat would be featured front and center, not only because he's president, because he knows a lot about technology. But his view was that we could sort of leapfrog the competitor to the north by designing a web portal, an internet presence that would give Wharton branded high-quality research on business and economics to a much wider audience. And in fact, that's what we did. He not only was clever in devising and supporting the strategy, but he was especially fortunate in picking the person to head it. And that's Mukul Pandya, who was a well-known and a prize-winning investigative journalist, written for the Wall Street Journal, the New York Times, The Economist, and others. And he was given the charge of creating this portal. Mukul was able to do this in ways I still don't understand, because he had very limited resources. I think it was mainly his Rolodex and network of friends across the world, but his objective the first year was to get 3,000 subscribers. He ended the year with 33,000 subscribers. There are now 3.5 million subscribers to Knowledge at Wharton around the world. And it's translated into Spanish and Portuguese, Mandarin. There's also a portal for high school students and high school teachers that's become very influential. And he is actually helping mold the content for an hour or 2 hours, I guess, on Sirius Radio that includes interviews with 30 to 40 business leaders a week. So it's a remarkable enterprise that grew from literally nothing more than an idea at a dean's planning meeting at one point. So I think it's entirely appropriate today that the person to interview President Harker is Mukul Pandya. So please join me in welcoming our guest.
Thank you, Dick, for that very, very kind introduction. And thanks, Pat, for taking the time to speak today. And many thanks to everyone for being here. So we've been talking a lot about FinTech. And maybe we should start by taking a little rest from that before we come back to FinTech. And let's talk about what's on top of everyone's mind, especially when they hear from you. And when they think about you, the Fed president, the thought that comes to mind is inflation.
Right.
So what do you, this week, Chair Yellen said on Tuesday, I think, that the Fed may have overstated the strength of the labor market and the rate of inflation. It has come down to, I think, this year to 1.4%. What do you think is happening on the inflation front? And are rate increases justified this year, next year? What are your views?
So what's happening in monetary policy land? Well, first, let me thank Mukul, you and Dick. By the way, I'm still doing railroads. Instead of steel rails, they're financial rails, right? They're rails of the payment system. So it's all railroading. And I want to thank Jalapa and the whole team and all our sponsors and supporters. This was a great conference. So what's happening in monetary policy? And I'll put the inflation picture in context. So if we think about GDP growth continues along just as we pretty much have anticipated according to our forecast, running slightly above trend around 2.3, 2.4. You can pick a number somewhere north of 2. Q1 was weak. Q1 is always weak. You should recognize that we have a seasonal issue with measurement of GDP in Q1, and so take that with a grain of salt. Q2 was just revised up slightly to slightly over 3%, 3.1%. So in terms of GDP, things seem to be going along just fine. Now, of course, the devastation that we're seeing from these hurricanes, this horrific devastation, is obviously terrible for the people who are involved, and our thoughts go out to them. But in terms of the economy as a whole, the best estimate right now is that we'll see about 100 basis point decline in GDP this quarter, and then it'll bounce back to about 1.3% in the subsequent quarter, some number around there. So it will have an effect, but it'll be a transitory effect as that works through the economy. So that's on the GDP front. On employment, I think the best I can say, and by the way, everything I say are my views alone and the views of nobody else in the Federal Reserve System or on the Federal Open Market Committee. But with respect to employment, we're running below what most people would think is the natural rate of unemployment. The labor markets feel really tight, and that's not only in the data in terms of unemployment, but you look at the JOLTS data, the job opening and quits data, things are really tight. And you're hearing this. I mean, yes, the plural of anecdote is not data, but we're hearing this over and over and over again of the skills mismatch question. Companies can't find the skilled workers. And again, we're not talking about PhD economists and computer scientists. We're talking about truck mechanics, electricians, plumbers. You can go down the list. There's just it's a very tight market. Now, we get to the inflation question. So if that's true, where did the Phillips curve go? Yeah. Right? What happened to it? Why did it just disappear? Well, the conventional wisdom is it's flat, but it's been flat for a while, and that relationship between unemployment and inflation we're just not seeing. So what's happening with wages? Well, they are flat, but some recent work that was done by our colleagues in San Francisco point out the fact that if you look at somebody who's staying in a job through a sustained period of time, their wages are going up well above what we're seeing on average. It may be just a compositional shift. Part of the story of the wage issue is that we, the boomers, are retiring, high-priced boomers being replaced by lower-priced millennials. Mm-hmm. And that is keeping the average down for now. Again, there needs to be more work in this area, but we are starting to hear and see some wage pressure. Now, there's some recent work done by Mike Dotze and his colleagues here at the Philly Fed Research Department on the Phillips curve. And so the conclusion of that work is whether it's dead or not, for the last several decades, it's not been a very good predictor of inflation, period. And there may be other metrics and other measures that are better predictors of inflation than what we've traditionally thought of with the Phillips curve. So that is the one thing, if you think of our dual mandate, that is problematic, is inflation. The job market seems to be incredibly healthy on average. Again, there are pockets where we need to bring people off the sidelines into the labor force and help them get the skills they need to, and that's something we're doing here in Philadelphia with what we're calling the Economic Growth and Mobility Project. It's working with communities, trying to do research and outreach in that area. Things like apprenticeship programs. We just put out a report on apprenticeship programs that are not just they're not your mother's and father's apprenticeship programs. They're no longer just in the trades, but you're seeing it in IT and healthcare, financial services. Apprenticeships are now becoming, as the market's gotten tight, one way for companies to get the talent they need. So on inflation, we are running below our 2% target, and that, now, only for bankers and central bankers is this a concern, that, oh my gosh, we're behind on the 2% target. The average American walking out in the street right there saying, I have a job, inflation's 1.5%, life is good. And the Eagles won an amazing game last week, right? So, I mean, what's wrong with this picture? Everything's great. Well, of course, there are risks when it comes to, bankers would like higher margin, obviously spreads. And we have risk of if and when another negative shock hits the economy, having the leg room to be able to move rates down, that is a problem. So inflation is the one area that does give us a little bit of pause, gives me pause. And it's a complicated story, right? And it may be that the Phillips curve or Phillips curve-like mechanisms will reassert themselves. But there's also work being done here in Philly, led by Leonard Nakamura, that is pretty persuasive that we may be overstating inflation, even as low as it is. And as a result, we may be understating productivity growth in the economy. And Leonard's favorite example is the iPhone. We no longer have a GPS. We no longer have all these other things. It's all on the phone. We no longer have a Game Boy. I used that once at a college campus and nobody knew what I was talking about. So we no longer have all those things because we have the iPhone 10 years out. But we don't know how to capture that shift in the statistics. We can do it hedonically in retrospect, but in real time for policymakers, we're having a hard time figuring out how to capture that. So I think that then leads me to be, as a policymaker, to say, well, given that, let's just let things play out a little bit. Let's just see how the data evolves over the next several periods. Today's PCE report was weak. So we'll have to see how this plays out. I think hitting a pause for a little bit on the Fed funds path is appropriate for two reasons. One, see the data play out. Second, we are unwinding our balance sheet, and that process will start, as we announced last week at after the FOMC in October. And so I think it's time to just let that play out. We'll start that process. That process, as I've said to other audiences, we want to do this in a way that is as exciting as watching paint dry. Right? I mean, we want to lay this out very clearly, what it is. The caps are very low, and the best estimate that I've seen is that will have an impact, the equivalent of a 25 basis point increase in the Fed funds rate over a 5-year, 4-year period. So we're not talking about a very large impact, but we don't know for sure. And I think prudence would call for just letting that happen, see how the markets react. I've still penciled in an increase in December and 3 increases for 18, assuming that inflation comes back. But I do emphasize the word pencil in. We'll just have to see how things evolve.
So we'll keep the pencil fairly light for now.
Right.
But just to follow up on the last point you made about the unwinding of the winding down of the $4.5 trillion balance sheet, how long do you think the process will take?
It'll take a while. It'll take several years. And again, the question is not so much the timing, but what are we going back to? Right. That's what you really need to know. And there, if you just do the math, so our currency liability, say, call it $1.5 trillion, and then we have about $400 billion in the Treasury account, plus some other foreign reverse repo and little things here and there. So we get up to some number, call it $2 trillion, right? So the question is, what do we need in order to effectively run monetary policy, right? To execute monetary policy. Well, this gets into a debate about whether you want a floor system or a corridor system, and you need to know that elasticity of the demand for reserves. We've been way out, right, on that curve for now quite a while, so we're not quite sure in this economy what that elasticity is. We're on the flat end for sure. And there's some view, and I'm sympathetic to this view, that a floor system makes some sense. The issue is we don't know when we stop being in a floor system and go into a corridor system. That is when the elasticity increases. Again, there's some recent research by some of our economists here that said, you know, that number could be as high as $1 trillion. We just don't know. And others will say, well, it could be as low as 100 billion. So given the tried and true scientific method of picking the middle, all right, you pick some number in the middle and it get you to a balance sheet of 2.5-ish, somewhere around there going forward. So that's really when but we'll know it when we get there. I mean, we'll be able to see how the market's reacting. We'll be able to respond appropriately.
Looping back now briefly to the topic of fintech, which is, we've had some fascinating conversations over the last couple of days on this. And one thing that has struck me in listening to all the wonderful speakers is sometimes it seems like we almost have this tsunami of financial technology innovation going on everywhere. But to what extent do you see it as being revolutionary and truly disruptive? And to what extent is it evolutionary and something that can be integrated into the existing financial system? I mean, it would be wonderful to have your overall perspective on that issue.
Yes. I think it can be both, right? It doesn't have to be one or the other. That there are clearly important, and we've heard from people here, important innovations happening in the market. That said, financial services have been in the business of innovating with technology for a long, long time. Right? This is not something new to financial services. It feels different now because of it's not the traditional banking institutions and other institutions that are doing it. There are new entrants into the market. But as I think the conversation yesterday when I was here, we were talking about what I think people are finding out, not everybody, but they're very good at that innovation to the customer. But then I've got all this compliance stuff and I've got all this other stuff I have to worry about. And it may be better to partner with the institutions that know how to do that and also get scale. And this is not very different than many other industries, whether it's retail or you can sort of go through the history of this innovation. There are going to be the Amazons of the world that emerge. But then others will figure out how to adopt this technology or partner with people and be successful. The fundamentals don't change very much, right? People still want some basic things out of the financial system. You know, access to credit, they want to be able to pay their bills, they want to have safe and secure funds, right? And they want to have other services that can help them succeed, whether they're a business, small business, or a consumer. So I think those fundamentals are still there. It's just how we deliver them is changing, and that will continue to evolve. So I think it can be both.
So in addition to the revolution versus evolution issue, the other big theme that has come up in the past couple of days is what are the key benefits of fintech and how do you see the trade-off between the risks, the benefits and the biggest risks of fintech?
I think there's clearly, and you can see the uptake, again, not only in the traditional banks, but also in the new entrants. There's clearly a desire, and I'm one of them, I don't walk into a branch unless I guess I want to yell at somebody. That's about the only reason I would. I enjoy having access to all the mobile platforms and all the ability to do that. And I think that's the advantage that we're seeing across the board, right? And so hopefully we'll also see an advantage of people who are marginalized in the financial system being able to get access to the financial system. I think for me that's more aspirational right now, but I think it's really important. And I think it's important for the system that we continue to have ubiquity, that everybody can have access and plug into the financial system. And in particular, if there are entrants who are coming into the market who can bring the unbanked into the market, help educate them about how to create a sound financial future for themselves, we're all better off as an economy. The risk, I think the large risk, is that many, not all, but many of the new entrants were born in a period where they've never seen a deep downside of a business cycle. Right. And banks generally have been through that. They know how to manage that risk. If there's a concern I have, is that the institutions, to make sure they have the proper risk procedures and policies to protect themselves when that happens. We will, I'm not saying when, because nobody really knows when, but we will have that downside of the business cycle. And to make sure that institutions are protected and hence consumers are protected in that process, I think is critical.
Fintech is such a sort of catch-all phrase. It's so vast.
Yeah.
So the next few minutes, I was wondering if we could drill a little deeper into some specific areas of fintech. And one question that came up yesterday that was very interesting was in the session with the OCC's acting comptroller. There was some discussion about the fact that Barclays, Credit Suisse, and many of the large financial institutions have now formed a consortium to create a digital currency. Right. Japan also, as you may have seen in the Financial Times this week, some leading Japanese banks are creating their own digital currency. I think it's called the J-Coin, with the support of Japan's central bank. So, looking to the US, do you believe that the creation of these digital currencies will threaten the ability of central banks to maintain control of money supply?
I'm not sure yet. At this point, I would be on the side of sort of doubting that for a couple of reasons. One, I agree with the acting comptroller that we should let the market evolve and see how this technology evolves. And we should not, whether we can create a sandbox or other ways of doing it so that people can have the ability to innovate. That said, I think we have to, some of the fundamentals haven't changed. For the economy as a whole, the paper that's in your pocket that we call money only has value because we believe it has value, because we believe that the government stands behind it. Right? It's all a trust issue. And so whether cryptocurrencies and other forms of currency emerge, I think the basis of that has to be how do they create that trust. In the case of a central bank issued digital currency, it is the government standing behind it, right? The sovereign state standing behind it. You could have other models of that happening, but they have to play out over time. Because again, everything can work in good times. It's when the bad times hit. And the other issue I am personally concerned about is whether it's a government issued or a central bank issued digital currency, or another large player comes in and issues this digital currency. When things really go bad, where do Americans turn, right? I mean, if things really turned out bad, well, they're going to come back to the government. That's been the history of the country in recent vintage. And so we'd have to think through that. And again, this is one where we're not ready for this yet. We're seeing it evolve. But it is something we continue to study, and I continue to study and learn from, and the experience of others who have done this.
To make sure that things don't go bad, the role of the regulator is very critical. Yeah. And the question there is, how can you regulate in such a way that you mitigate the risks that you are talking about? And even more fundamentally, how do you regulate an algorithm?
Yeah, that's a good question. I don't know yet. I think the answer is we have to continue to study this, and as these technologies evolve and the innovation evolves in the market, we need to continue to work and study how this is evolving. The issue of regulating algorithms is interesting. One of my colleagues, a computer scientist, is doing some interesting work on fairness in machine learning algorithms. If you think about all of you in this room and everybody's adopting machine learning algorithms, but how do you plug into that some sense of fairness, right? Whether it's required by a regulatory constraint or just you believe that's part of your business, the right way of doing business. That's actually a lot harder than it sounds, apparently. It's a very difficult thing to do. So before we even think about how do you regulate an algorithm, how would you even build an algorithm that would have that sense of fairness in it is a technical, but a fairly deep technical question.
The fairness issue is especially interesting because the presentation that we just heard this morning about how important financial inclusion is as a dimension of fintech. I mean, we just heard presentations from companies that are being so proactive in bringing unbanked and underbanked populations and lowering their costs of borrowing, etc. How do you see the relationship between fintech and financial inclusion?
Oh, I think done right and done well, it can have a tremendous impact. But we also have to recognize that we are human beings, we are flawed human beings, and there are also players in the market who are behaving in different ways. And so you hear these stories all the time. I hear these stories constantly of small business in particular getting into a situation where they didn't quite know what they signed up for, and then they walk into their community bank and say, I got to get out of this deal, it's killing me. Right? I signed up online for this thing, and I thought it sounded good, but I didn't really understand it, I guess, and now I'm really in trouble. And so there are good actors and bad actors in any industry. Financial services is not very different than anything else. And I think that is the role of the regulators, and not just at the national level, but even if there was no national OCC charter for a fintech company, there's still state regulatory requirements with respect to fairness to the consumer and so forth. So there's always going to be some form of regulation. And my message to the fintech companies is get involved with the regulators early and often to start forming what makes sense to protect the people who want to do it right? Because I think that can protect the innovation, right? This sphere of innovation that you all need and we want as an economy. But if there's too many bad actors in there, that can stifle that innovation, right? It can squash, because we know how regulation goes. It's always been this case. We tend to overreact to a crisis. When something bad happens, the pendulum swings too far. It's better to be in the conversation right now about what those regulations look like now, whether it's at the national level or at the state level.
Well, one area where consumers especially need to be protected is because what's happening with cybersecurity.
Yeah.
Especially in the wake of what's happened with Equifax.
Right.
What is your view about the cybersecurity environment and how should consumers be protected?
So I think one of the big challenges for consumers right now, and actually we had a pretty robust conversation with a group of bankers the other day. So everybody can try to protect that account at that bank. But the consumer needs to figure out how to protect themselves. And increasingly, that's not just in financial data, but it's health data. You can go down the list of all the things, your identity. It creates challenges for the consumer and for the financial institutions. We were talking, I know, throughout the conference on AML and BSA. That's going to get harder. I mean, much harder. How do you really know your customer? I mean, especially if you've never, even if you physically see them, given how much data and information is now out there about all of us, how do we change the system? How do we innovate to protect my identity, not just my financial identity? So all of us, because we got hacked here when OPM got hacked, so everybody in the Fed has credit fraud detection and so forth. But we have to continue to innovate in this space too. I actually worry about this a lot because if we don't do this, again, a lot of the innovation that you are all fostering can be really stifled when customers just say, yeah, I'm going back to microfiche and coins, right? Because I've been hacked so many times and I've lost so much money and it's such a hassle to keep trying to clean up my credit or my health records or my false tax returns that somebody put into the IRS that, man, I'm just dropping out of this. That would be a dangerous step, I think, for the industry, all of you. But what it means, though, is some innovative players have to come in with, I think, different ways of thinking about how to protect our identity.
Just have a couple of final questions before we open it up for everyone else. Looking to the future, maybe 2 or 3 years, what is your most optimistic and your most pessimistic scenario about fintech? And between the two, since you said yes to one question before, what is your most realistic scenario?
So I think the optimistic one is, we were just talking about, that fintech not only reaches the consumers that have deep pockets, but also starts to bring the marginalized consumer into the market, right, in that financial inclusion. That's critically important for the economy. The negative is that, again, whatever it is, there's continued hacking or there are regulatory issues that stop the innovation in this industry, right? That just, you can see if we don't get this right, and if the consumer doesn't learn to trust these innovations, they simply will not happen, right? And so it's all a trust game. And so I think that's the realistic scenario is there are going to be people who do it well. There are going to be people that don't do it well, people who succeed, people who don't. That's the market. And I think we just need to make sure that we as regulators continue to make the playing field level and not get in the way to the extent we stifle this innovation.
And let me ask one last question before we open it up. What is the biggest prevailing myth about fintech? And if you could say one thing today to dispel it, what would that be?
So for my kids, somehow, it's that money magically appears in an account. So I think that's probably the biggest myth. Like, I don't know.
That may not be limited to fintech.
Right. Yeah, at least when they had to steal it out of my drawer in my bedroom. But now it's just that somehow a lot of the basic rules of financial services don't seem to apply. Also, the other myth, which I am very concerned about with my 3 millennial children, is not all technology is equal. Some of this stuff, you're putting yourself out there at tremendous risk because it's not very secure. They don't think about that. And so I think that's one of the big myths that I know you are all concerned about and we're concerned about as well.
That's a great point. And on that note, let's open it up. And who wants to go first? Yeah, there's a question.
Hey, I'm Michael at CoinDesk here, and thank you for asking about the work with utility settlement coin. I'm also curious what your thoughts are on the possibility of maybe someday issuing fiat on a blockchain. Is that something that you're exploring?
Well, I think there's work going on right now in terms of more exploration of and watching what is evolving in the market, not just here in the U.S., but globally. I don't think we're ready to do that yet, but it is worth continuing to study. I don't think at this point, though, I would say, at least for me personally, I don't know enough yet, and I don't think we collectively know enough yet to be able to make that decision.
Right here.
No, here.
This is Will from University of Chicago. I do have a question for President Harker. You mentioned about the optimistic outcome where there's more financial inclusion. I think there's also a lot of discussion related to fintech on democratizing financial services or kind of disintermediation, so to redistribute the surplus to either consumers or some new entrants in the market. What's your view on that? Is that a function that fintech is already performing and can optimistically perform well in future?
Yeah, that's a good question. So I think you really have to break down the services. I don't think you can give, at least in my mind, an answer for financial services writ large, right? It's service by service, sort of what kind of things could be, will be disintermediated or continued disintermediation. I mean, that's the other thing. It's not like all of a sudden that this is happening. It's been happening for a while. So I think it really depends on the actual service itself. And that, to me, comes down to, take 2 completely different industries. Having just bought and sold a house, I used a real estate agent. Why? because I don't buy and sell a house very often. As opposed to, I don't use a travel agent. Why? Because I travel a lot. And so I think some of it is the familiarity with the service for the consumer and the opaqueness of the information. That's very clear in the real estate business. You don't see there's not a lot of transparency into some of the things that happen. So I think if you map out, you parse out what financial services provide, there are going to be some services that people use on a routine basis. They easily can get the trust to do it. And people can be disintermediated. There are others that people do on a very infrequent basis. And there may be some disintermediation, but often if I'm really sort of lost, I need to find somebody that knows what they're doing because I don't think I know what I'm doing, right? Because the disintermediation makes a big assumption, right, in my mind, that everybody is a rational actor that can be fully informed on this thing. Well, that's just not true, right? There's, some things that real estate's a good example. No matter how hard I tried, those local agents have more inside information about the market than I can ever get, right? And so there's no way, no matter which website I go on, I can't find out about the plumber who put in that work in that house, whether it was good or bad, right? It's just hard. The second thing is there are a lot of things I could do it, but I just don't want, it's just not worth my time to worry about it, right? So yeah, because it takes so many cycles of my brain to think about this, and I only have so many in my life, and I'm not going to spend some on these things, right? I'm just going to let somebody else do it and not worry about it. So I think it really depends on those specific markets and the taste of the consumers, right? So there'll be different flavors for different people. There'll be different types of people, but there'll be different players in the market too, and there'll be a matching issue. So I think there'll clearly be disintermediation. That's just been the nature of what we've seen in many other evolutions of technology. But how it turns out, it'll really depend on the specific service.
Yeah, here's a question here.
Thank you, President Harker. It's very interesting remarks. Going back to Mukul's question about the framework that the Fed would eventually return to, on Wednesday, the New York Fed published a blog post that linked the ability to pay the interest on excess reserves exclusively to going back to a floor system. I was wondering if you think that the Fed would continue to need the ability to pay interest on excess reserves if they went back to a corridor system, or would a corridor system with a floor at zero be acceptable?
Yeah, that's a really good question. So, I mean, just to put it in context for those who are not deeply immersed in monetary policy world, if you're in a floor system, what defines the floor? Well, it should be the Fed funds rate, but the trading in the Fed funds rate, the reason there's no demand is there's very little trading in the Fed funds market. So Congress, prior to the Great Recession, gave the Fed the authority to pay interest on excess reserves. And during the crisis, asked the Fed to accelerate its implementation so that we had that tool. That creates a floor. It's a leaky floor because it's only open to certain players in the market. The overnight reverse repo market actually provides the floor. And so the Fed funds trade between those two. So if we truly went back to something that was a corridor system, we wouldn't need to have that tool in the same way, assuming we can stay in that corridor system. I think right now it is imprudent to remove that tool in any way, shape, or form. I mean, it is what we have right now. Without it, we will have a very difficult time. The New York desk would have an incredibly difficult time trying to execute what the Federal Open Market Committee says. So the committee says, open market desk, thou shalt raise the Fed funds within its 25 basis point range, and they need the tools to do that. Right now, IOER is really the only one they have, along with the overnight reverse repo.
Maybe one last question, perhaps? No, I think you, oh, yeah.
In one of your responses to questions earlier, you said something about come and talk to the regulators frequently. The problem is, as I see it, is that which regulator? So many of these new business models we see sort of fall in the interstices between different types of models. Is Bitcoin a security? Is it a currency? So who do you talk to? I mean, there doesn't seem to be that much coordination between the regulatory agencies in trying to figure out what to do in this scenario here. Right?
Yeah, that is a fair criticism, but actually that's why I think meetings like this are really important. Because when I mean talk, it isn't that we just have to sit over coffee and chat, one-on-one, but I think we are collectively trying to figure this out, right? I mean, I think it is a fair criticism that we haven't completely figured it out, because frankly, nobody's completely figured it out because it's a fast-moving target. And so I think these kind of gatherings really matter. And the follow-up from these kind of gatherings, continuing the conversations, really are important. I think there is a movement within the Sup and Reg community across at least the federal agencies to start to have some deeper conversations. But honestly, in this case, as still a dyed-in-the-wool academic, I actually think the academic community can play an incredibly important role here in both providing the research, the different perspectives, and some of the convening. Yes, we can do these convenings, but I think it's also important for academic institutions to play a critical role in this area. When you see this kind of somewhat hazy future of what this is going to look like, and that's starting to happen. I mean, one of my colleagues, Bill Laufer at Wharton, just had a conference. He's a lawyer, and so they had a conference that's more on the regulatory front at Penn last week. The more of those we have, the more we talk about this, the better off we'll be.
With that, I think it's time to thank you, Pat, for your wonderful comments and insights. And please join me in thanking Pat for...
Thank you, Mukul.
You were fantastic. You were fantastic. Well done.
There you go, Bill.
And they're going to the podium.
Yeah.
Are you going to introduce us?
Just let us introduce ourselves. Yeah. Self-starters. Are we breaking hot at 12:30? Is that the... Okay.
I'll give you about 15, 17 minutes.
Perfect. Yep.
Have time for questions. Quick thing. The files are in there.
Okay. All right.
I don't want to waste time with introduction.
Thanks.
I'm not quite sure how we find our slides, but you just click it, and then I have to back out of yours and click
How
mine. Okay.
do I make it expand to the whole thing once I click
It should click up.
Yeah, I think if you just click on it, because he won't be using one, you'll automatically pop up.
It will pop up
I
in
said-
full screen mode?
Yeah.
Yeah, I just need to know how to get out of yours.
You can go up there and check it, but it should click to your thing. He's a man. He wanted to know how to click on to expand. Yeah.
Oh, then I pick mine. Okay. All right.
Okay, let's. I want to keep us on time and do the next panel so we can get to lunch. My name is Bill Lang. I'm with Promontory Financial Group, an IBM company, and our company Promontory has for a long time been known for its intersection between developments in the financial sector and regulation. And with the acquisition of IBM, obviously this question of the intersection of technology, fintech, and industry development and regulation is at the core of our interest. I'll just say it's thank the organizers of this conference, Jalapa, Bob Hunt, Kozjan, Ken Kopecki. This has really been a terrific event, and then just personally for me, having spent 13 years in this building, it is nice to be back and see lots of old friends. So without further ado, all of the program, all of the individuals' bios are in the program. I don't want to waste time on that. So let's go ahead with Bill Nelson. Thanks, Bill.
All right, thank you. Thank you, Jalapa, and thank the organizers of the conference. I appreciate the opportunity to be here. It's been interesting, timely, and appreciate the chance to get a chance to speak to all of you. I'm Bill Nelson. I'm the chief economist at the Clearinghouse Association and Payments Platform, and also before that, for 24 years, I was an economist at the Federal Reserve Board in the Division of Monetary Affairs. So I want to start out with a disclaimer, and not just the usual disclaimer. My work at the Clearinghouse and at the Fed before that has been focused on bank regulation and financial stability and monetary policy. I am not an expert in digital currencies. So I thought today I would discuss digital currencies from a financial stability and monetary policy perspective. Given my non-expert status and for all the usual reasons, I'd like to emphasize that these are my views, not those of the Clearinghouse. My talk will first address financial stability and issues associated with digital currencies, and then turn to monetary policy issues. By digital currencies, I mean private sector digital means of payment, such as Bitcoin, but I will also discuss some of the issues associated with central bank digital currencies. I make no pretense of this being independent work. I've drawn heavily on studies of the issue by the Bank of England, IMF, BIS, and FSB, and benefited from discussions with a number of experts at central banks, academia, and the Clearinghouse. So years ago, after the 9/11 terrorist attacks, I was involved in some of the planning for possible future terrorist incidents. When discussing with Roger Ferguson, the vice chairman of the Federal Reserve Board at the time, the possibility of a problem with FedWire, the large value payment system operated by the Federal Reserve System, my colleagues and I explained the extraordinary number of backups, hot, warm, and cold, that the Fed maintained. After discussing each one, Roger's response was, what if that one was destroyed too? In the end, we had to build a spreadsheet-based additional version. Well, the principal lesson I drew from the experience is that it is impossible to satisfy people when it comes to contingency planning. It also illustrates the extraordinary importance of the payment system for financial stability and the risk posed by central points of failure. In that regard, digital currencies, at least those based on distributed ledger technologies, are attractively resilient, at least in principle. In practice, however, at least to date, distributed ledger technologies appear to be more, not less, subject to fraud and cyber risks than central bank payment systems. Indeed, the last annual report of the U.S. Financial Stability Oversight Council lists technological problems with Bitcoin and the exposure of distributed ledger technologies to fraud as potential emerging threats to financial stability. That said, with respect to financial stability, currently the issues seem to be concentrated in digital currencies as an asset, not as a currency. A number of studies, including a recent Fed working paper, report that the majority of Bitcoins, for example, are held by investors, not as a means of payment. With Bitcoin value up 400% this year, there has been a lot of speculation about whether there is a bubble in Bitcoin prices. Usually a bubble is defined as an upward deviation from fundamental value of an asset, and it is hard in this instance to determine what fundamental value actually means. But the question boils down to whether recent price gains have been driven by expectations of future price gains and are subject to a sudden reversal. In his book, Irrational Exuberance, Yale professor and Nobel laureate Bob Shiller has argued that asset price bubbles are frequently tied to technological change and the resulting promise of large but uncertain returns. He points out that there were bubbles associated with the advent of rail travel in the 1900s and mass production in the 1920s. Professor Shiller and others, including recently Jamie Dimon, have indicated that they consider Bitcoin's current valuation to be a bubble. The popping of asset price bubbles does not necessarily lead to financial stability problems. For example, the bursting of the dot-com bubble in 2000 had limited financial stability consequences. Several additional preconditions need to be met. Generally, for the bursting of a bubble to imperil financial stability, investments in the asset need to be funded with short-term debt, and exposures need to be material and connected to core providers of credit to the economy. As far as I can determine, digital currencies have none of these characteristics currently. The asset class at just north of 130 billion may be too small to be material. For comparison, there was 800 billion in subprime and non-prime RMBS outstanding at the end of 2006. My view at the time was that that amount of non-prime RMBS was simply too small to constitute a systemic risk, which proved to be spectacularly wrong. Also, I'm told that there is little leverage supporting digital currency investments, including in initial coin offerings, or ICOs, in which firms raise capital by selling digital tokens that can be turned in for a service by the firm. It seems to me that the risks to financial stability from digital currencies... Right. There we go. To financial stability from digital currencies currently or in the near future are likely to be concentrated in economies where the currencies are in greater use, either because there is less confidence in the domestic currency or the digital currency allows individuals to evade capital controls. Even in those cases, while large and rapid declines in the value of the currency could lead to widespread losses and even panic, it is hard to see how those losses would be conveyed to the core financial intermediaries in the economy unless those intermediaries had provided credit to support speculation. The most serious financial stability risks from digital currencies seem to be only possibilities, not yet realities. If a digital currency came into widespread use as a currency, then we would be in a world where its value was relatively stable and it was seen as a low-risk asset. Otherwise, it would not be used as a unit of account and store of value. As we saw in the financial crisis, financial stability risks are concentrated in assets that are considered to be safe, not assets that are considered to be risky. If there were a sudden loss in confidence in the digital currency, savers and investors would switch rapidly to dollars, assuming that this was in the United States. Financial institutions that were net long the currency would make losses, deposits denominated in the digital currency would be withdrawn, and financial institutions would be unable to roll over short-term borrowings denominated in the currency. If there were multiple digital currencies in use, loss in confidence in one would likely lead to loss in confidence in all. For this reason, the appropriate measure of the size of financial stability risk posed by digital currency is probably the total amount of such currency outstanding, not the amount of an individual currency. The central bank would be able to operate as a lender of last resort, although only with difficulty. Consider a commercial bank that had illiquid assets denominated in the digital currency and was experiencing a run on its deposits denominated in that currency. At least in principle, the central bank could purchase the digital currency in the open market, lend the digital currency to the bank, and take the bank's digital currency assets as collateral. But it would take time for the central bank to purchase the digital currency, and effective lender of last resort intervention usually needs to be fast. The purchases in the necessary size might be especially difficult if, as seems likely, the markets for the digital currency were disrupted at the time. On the other hand, in this situation, there might be many eager sellers of the currency. Similar problems arise when a central bank needs to provide lender of last resort support in a foreign currency, and the major central banks have established standing currency swap arrangements to facilitate such operations. In the digital currency case, however, there is no counterparty with which to establish a swap line. If the economy had converted entirely to the digital currency, I think there are two cases to consider. In the first case, all payments take place in the digital currency platform, and there is no central bank at all. In this case, it is unclear there would be a public agency that could act as a lender of last resort. While a government agency or consortium of private banks could lend, the lending would not expand the total amount of liquidity available, so it could not meet the generalized increase in demand for liquidity that occurs during a financial crisis. The second case is more complicated, but perhaps more relevant. If an economy adopted a digital currency, banks would make loans denominated in that currency, take deposits denominated in that currency. The digital currency money supply would equal bank deposits denominated in the currency and digital currency held outside the banking system. If banks were required to back deposits with digital currency one for one, then the money supply would equal the quantity of digital currency. But if banks only had to back deposits with a fractional amount of digital currency, then the digital currency money supply would exceed the quantity of digital currency. The situation would be analogous, in some ways, to pre-Civil War United States, when the country was on the gold standard. But banks were able to issue notes that were convertible to gold. Over time, the ratio of notes to gold went up, however, and when things went badly, there were runs on the banks folded or suspended conversion of notes to gold, and the panic got worse, with substantial adverse effects on the economy. In this second case, it is easier to see a role for the central bank, which would itself take deposits from commercial banks. The central bank would be well positioned to act as a lender of last resort to the banks, although it would be limited by its need to maintain an adequate stock of the digital currency to back the commercial bank deposits it had received. Total conversion to a digital currency is a convenient, although admittedly implausible, point to begin a discussion of the monetary policy implications of the currency. The situation would, in some ways, be similar to instances where an economy had converted entirely to the dollar, or to the situation of an individual country in the euro system. The central bank, if there were a central bank of that country, would not be able to stabilize the macroeconomy. Moreover, because the supply of digital currency is fixed or exogenous to the demand for currency, economic and financial stability would be amplified, and financial volatility would be amplified, although it may be that changes in the design of digital currency schemes could help limit the damage. If the quantity of digital currency is fixed, then as the economy grows, the real value of each unit of the currency would rise. Put another way, prices of goods in the currency would be falling. There would, on average, be deflation. Deflation is bad for an economy. Businesses and households tend to put off expenditures because items will cost less in the future than at present, holding back economic activity. The contractionary consequences of deflation are largely a result of the fact that interest rates generally cannot be negative. But the zero bound on interest rates is tied to the fact that paper currency always provides a zero rate of return. In a digital currency world, that restriction on interest rates could possibly be lifted, a point I will return to in a moment. In any case, the deflation problem seems partially fixable by allowing the outstanding quantity of the digital currency to grow with the economy. Even so, unless the quantity of the digital currency were able to move up and down with seasonal demand at least, and respond to other outside shocks to the economy at best, there would be excessive volatility of interest rates and a tendency towards financial crises, which often happened historically during seasonal tightness in demand for money. The Fed was created to provide just such an elastic currency. If the economy operated partially in the digital currency and in the public currency, and the digital currency had a floating exchange rate, the central bank would still seem to be able to moderate the business cycle and control public currency inflation, but with less precision because of the volatility coming from the digital currency side of the economy. Some of the most interesting recent discussions about these monetary policy issues concern central bank digital currencies. While a central bank digital currency can take the form of an anonymous token akin to digital cash, similar results, apart from anonymity, can be achieved by simply allowing universal access to central bank accounts. If the economy were to convert entirely to such central bank digital currency, the zero lower bound on nominal interest rates could potentially be overcome entirely. The central bank could pay a negative interest rate on the accounts, driving its policy rate as low as needed to achieve the necessary economic stimulus, at least in principle. I suspect there may be insurmountable political hurdles, though, if the public were forced to hold digital cash and then forced to pay interest on it. At this point, many of the financial stability and monetary policy issues associated with digital currencies seem remote. Regarding monetary policy, no digital currency seems likely to come into sufficiently widespread use to complicate the central bank's ability to moderate the business cycle and control inflation. For those who are fans of policy rules or a gold standard, a digital currency-based monetary system may seem attractive for the same reason. It provides a way to limit central bank discretion. However, usually such schemes are proposed as a means to overcome a perceived tendency for the central bank to generate too much inflation. In the current environment, where inflation has been low for decades and is, if anything, too low, there does not seem to be a need to boost central banks' credibility or rein in their inflationary tendencies. And even in countries or situations where the public has lost faith in the central bank, it seems inconceivable that a private digital currency would be adopted instead of, say, dollars. A fundamental characteristic that the public demands in a currency is trustworthiness, and it does not seem credible that the public would want to convert to a currency subject to fraud or technical errors with no person, firm, or government standing behind it. For the same reason, some of the more extreme financial stability risks also seem highly unlikely. In particular, if a digital currency does not come into widespread adoption, then banks won't be subject to digital currency runs, and the central bank won't have to struggle to be a digital currency lender of last resort. Nevertheless, other financial stability risks seem more serious. It has been impossible to read about digital currencies and initial coin offerings without concluding that there is a mania going on. While it seems likely that the fallout from any popping bubble will be limited, you never can be sure until it happens. Thank you.
All right, Jalapa, thank you very much for the invitation. My name is Jim Cunha. I'm from the Boston Fed. I'm a senior vice president. And not surprisingly, these are my words, not them, those of the Federal Reserve System, especially about such a fun topic. I tend to go off script and say a lot of things. But I'm a technology guy. I'm a payments and technology guy. So for the last 35 years, I've been researching, building, and running payment systems and trying to educate policymakers. And as a non-economist, that means I can draw conclusions with no math whatsoever. And I find it liberating, so I highly recommend you try it. So I'm going to talk about 3 years of development. I'm going to talk about real things happening in the world, so not theoretical things, but real things happening in the blockchain world, in interbank settlement and securities, and also in cross-border payments. The first two, a gentleman yesterday mentioned Bitcoin, and obviously I can't go into all the details, but Bitcoin's an open, permissionless system where there's no authorities anywhere, and the miners are either in China or in some garage in the Innovation District up in Boston. And the first two of these are not the systems that the people in the industry are looking at. If you're moving big money and dealing with securities, you don't want a system where the miners are somewhere else in the world doing the validation of the transaction. So these tend to be closed systems on new platforms, not on Bitcoin or Ethereum, but on other platforms that tend to be built for financial services. So for interbank settlement, first of all, there are many different applications of this, different models. I'm going to be a little bit generic here. They're bank-centric, so this is not a currency or a coin that's going to be used outside of the banking system, except for maybe some of the large utilities, but not for the public. This is not public fiat currency. It's fully reserved, generally, so it's good funds. And generally, the central bank's involved in holding money and issuing tokens, but not always. The initial use case is delivery versus payment. So if you want to change the ownership of $100 million worth of securities, you can't do that until you know the money is in the bank. So if you have a digital token that can be moved from one bank to another and then the security moves, that has a lot of potential value. These are some of the particular goals that you think about in a system like this where you're talking about interbank settlement, final and irrevocable. So if there's a consensus method, we're not going to use proof of work because proof of work is probabilistic. In other words, if you write to the Ethereum blockchain or if you write to the Bitcoin blockchain, that is not final and irrevocable, even though many people think it is. In Bitcoin worlds, it generally takes about an hour for that transaction to be deep enough into the stack that it won't be reversed. So Any system for interbank money is going to be deterministic, which means it's going to be a yes or no question. It's not going to be yes, in maybe a half hour you can check and see if your money is in the bank. So the consensus method model means a lot here. Privacy matters, so this is not going to be something where Bank of New York Mellon wants their holdings visible to everybody. So we're talking about a different type of platform. Queue management, the order really does matter. In Bitcoin, you have no idea when your transaction is going to be picked up. It does matter when you're moving hundreds of millions of dollars or securities. Can't operate totally decentrally. That means that the coin can move without the central bank necessarily being involved. Some models have it being involved, some don't. But if the Fed is not there, these models want the money to be moved in case of a contingency situation. And then capacity matters, obviously, for throughput. So now I want to talk about a few projects that are actually in the world. Jasper, we've heard, is a Bank of Canada project, and Stella, which is a ECB Bank of Japan. The first two are totally research. They've said, we are not going to issue a token. We are researching the possibility of doing it. Jasper's already finished up, and Stella is still in progress. But Stella was looking at feasibility, but also throughput of the consensus method. And I'll tell you about the findings in a second. We've heard about the utility settlement coin. I haven't seen a lot about that other than press releases. But the press releases, this is 10 of the largest banks in the world. The press releases have said, we want to bypass some intermediaries, and also we want to create a path for the central bank to issue a coin eventually. So I'm not sure how it's going to play out, but that's what's stated in some of the press releases. And then lastly, Ubin, I think is most interesting, the Monetary Authority in Singapore. They took the Jasper project output, and now they're creating a system with a liquidity savings mechanism built into it. And from what I hear from talking about them, what I read is that they actually plan on eventually having a system built off this platform if everything works out. Now, I wouldn't quote me on that, but that's my understanding is they're not just experimenting, they actually want to go someplace with this. Now, when I first heard about this, I didn't quite understand the business case, not the business case, but the economics of it. You know, what are we saving by taking a token from a central bank and moving it around between banks? And the Jasper project said the same thing. There's no real economic savings from this for the token, but if you also have automation in other areas, say securities, then maybe the markets in multiple areas together create the efficiencies. In the Bank of Japan, the Stella project, they said that the current mechanisms are sufficient for throughput for the ECB and Bank of Japan, but they don't scale up past about 250 nodes in the network, and the nodes in the network and the latency between nodes does matter. And for many jurisdictions, the capacity just wouldn't be there. So they think it's feasible, but there are limitations on the projects. So now to move to the security side of it. So if we have automated money and we have securities, is that the low-hanging fruit, if you will. So from a SWIFT report, they estimated about $40 billion in costs in the post-trade processing across the world. That's higher than we heard yesterday, but it's a lot of money, and it's a lot of friction. It's time, it's manual processes, it's reconciliations, something exactly that distributed ledgers are supposed to be getting around. But I said the challenge is not in the technology, it's in the business models changing. And that's one of the key things I say whenever I talk about this. I find the technology really sexy. I really like it, but it's really the business model and the trust model. So think of State Street moving $100 million worth of securities to BNY Mellon. They go through either DTCC or they go through the Federal Reserve. It's a hub and spoke. They trust us. They don't trust each other in this transaction. They trust us because we're authenticating everything. So even though this wouldn't be a Bitcoin-like system, it's a new business model, which means new trust models have to be developed. And that's the hard part here. Now, there's a lot of research going on. There's not real product yet in these areas, but there are a lot of securities-related products that are actually in production or close. For time's sake, I'll go quickly here. NASDAQ traded a private security on a platform that they built called Link. DTCC has announced that they will have a live credit default swap system in early 2018. And from the people I talked to, they think they're relatively on track. That's a huge development. That'll be a live platform on distributed ledger. We have some stock. We have the Australian Stock Exchange partnering with Digital Asset Holdings to build a new exchange down there. And Overstock, you know, the Overstock was the first major corporation to take Bitcoin, and The CEO is a self-proclaimed Wall Street basher. And what they want to basically do is eliminate any activity within Wall Street. They've issued their own private Series A venture on their own platform. So these are real life things happening. I don't have time to talk about ICOs, initial coin offerings. We've mentioned it here. And I will say, I would ask, is that a coin, a crypto coin? Is it a debt instrument? Is it a stock? Is it a Ponzi scheme? But whatever we think today, it'll be something different next year. You know, this is an amazing development of the ICOs, either for the companies themselves or even for how venture capitalists work. So it's just an area to watch. So in the world of payments, these are all cross-border platforms that use distributed ledger in some form. And this is just a few of them. There's many more. I don't have PayPal up there because I don't think there's a distributed ledger in your solution, but I was looking for distributed ledger blockchain solutions. You know, there's one thing, first of all, many of them are overseas because a lot of them are either trying to solve a cross-border, and they're a country where a lot of remittances go to, or they're trying to help solve a domestic problem as well. So you see a lot of foreign development here because, as we know from the PayPal data, there's a lot of cost and friction and opaqueness in cross-border. So I want to talk about just two of them and how they use distributed ledger because they vary. This is where I see a lot of cool innovation. The first is called Abra. And I'm not promoting any of these are just illustrative. But just say the person on the left wants to send $100 to their cousin in pesos. So what they'll do, they'll sign on to Abra, and Abra will connect them with someone who will change their US dollars into Bitcoin. And then they'll connect to the recipient and put them in touch with the market maker that will change their Bitcoin into peso. So Abra uses distributed ledger, and they use the Bitcoin network as an exchange currency. So obviously there's a little bit of time in there where you've got some foreign exchange risk, if you will, but it's done very quickly, so it's pretty minimal. But I think this is a cool combination of technologies to move money around the world relatively quickly. Next is Ripple. Ripple has a couple of models. This one in particular is, think of FedEx, the tracking system, without moving any packages. What Ripple does is it uses the normal ways of moving money from the US to someplace else or anywhere in the world. It negotiates with those parties, sets pricing, sets timing, and once they all agree, it tracks it. So the distributed ledger is just used to track a payment from point A to point B, not move the money. So they're just trying to get both a surety of the cost and a surety of the timing into this particular system. So there's an awful lot going in the cross-border space. And as a gentleman said yesterday, a lot of the technology, maybe this morning, a lot of the technology development comes from undeveloped areas like Kenya with M-Pesa, et cetera. So I think you're seeing a lot of the same thing here. They have a burning platform moving money to countries that don't have a good payment system or where there's a lot of opaqueness. So just lastly, observations. I think we're really starting to see adoption and development, but I still think we're 3 to 5 years from anything major that scales. I think the platforms themselves are really interesting, but there's more to be done in those underlying platforms, the distributed ledger platforms that are coming out now. As I said before, the trust models are much harder than the technology to get right. So that's where a lot of the problems are, and a lot of things fail because of the partnership issues and the legal issues. And then this is my last, is a quote I'm trying to refine a little bit more, but the disruptors begin the process, like they're going to take over the world and get rid of every bank and intermediary there. The incumbents first defend and say, "This, you don't know our job, you don't know our world," and then they partner eventually. That's what you're seeing right now. Every major bank has a partnership or is building their own platforms. Every single middleman in, NASDAQ and CLS and all of them, they're all partnering. SWIFT is partnering to try to do something. So here's where I think the partnerships will be what the ultimate success is. So thank you.
So we have some time for questions and discussions. I wanted to start off with a couple for each of you, and I'll start with Jim first. President Harker talked about the need for regulators and the Federal Reserve to better understand market developments and provide some thoughtful leadership in the areas of regulation. So what is the Fed doing to, in fact, take that route with blockchain?
The main thing one thing we're doing is we're learning and we're talking to as many people as we can. My job is I just travel everywhere and do speeches and talk to everybody I possibly can to understand what's happening in the market, because you know a lot more in the streets as far as what's going on. In Boston, we're doing experimentation. We are doing proof of concepts with different platforms. We are never going to, or in my lifetime, we won't put the platforms I'm doing now into production. We're trying to learn, but we're using Ethereum and Hyperledger Fabric. And then we're also trying to understand through the economics of it and educate our policymakers, because most people at the top of the organizations don't have a deep understanding of the real potential here of what this fintech could do, whether from regulatory, from a payments, or from monetary policy. So we have groups inside the Fed now that are trying to educate the policymakers to understand what's the real risk and the potential here.
Are some of them writing equations?
Yeah, yes. Oh, yeah.
Okay.
We've had some equations. I don't read them.
Bill, so the history of private monies has been, and as we heard from the comptroller, the acting comptroller, that agency was built around getting rid of private monies. So you talked about a situation where the risks are small because the market is relatively small. Will the market remain small because of the view that if it grows too much, the government will as it has in the past, get rid of private money?
So I don't think so. Basically, because it seems very unlikely that a digital currency would take the place of a public currency, or in a country that had abandoned its own public currency, something else like dollars. So it doesn't seem, as at least for the reasons of, if we don't act, we're going to lose the ability to control our business cycle and inflation. Those risks don't seem to be ones that I think are going to press the government into action. Now, there are, seems likely to be other risks associated more with financial stability, ones where, if the more commonly these things are, the more embedded in our economy digital currencies are, the more likely you're going to see, I think, leverage and short-term leverage taken to support positions in it, and you're going to see, increased risks from declines in prices, volatility in prices, technological fraud, and other, technological problems. And I'm sure that the government will feel a need to act to control those risks, but those shouldn't be it shouldn't be necessary in that case to cut off growth, I think.
Let me open it up for questions. Yes?
There's another aspect, which is the privacy issue. And if you look at some of the major groups that want Bitcoin to be used, these are, let's say, companies, groups that are causing security problems for companies. They lock up their files and then they say they want a certain amount of Bitcoin in payment because of the privacy issue. You have the activity on the dark web, including the ISIS, the people who want to buy weapons, buying and selling of stolen credit card information. So how does that play into the development that you're looking at in terms of these Bitcoin and other cryptocurrencies?
Sure. I think the most important, well, first of all, people used to ask for money because that was also anonymous, right? If they were doing a hostage situation. So I don't think it's the instrument as much as what you can do with the network. So almost every jurisdiction, you have to do KYC and AML when you're buying and selling Bitcoin. Now, what that's done is that's driven a lot of Bitcoin to other currencies, Monero and others that are billed as, harder to trace than Bitcoin. So I don't think it's the technology currency itself. I think you need to do as much as we can with KYC, AML, not squash the currency. And there's always going to be bad guys trying to use something to get their, to get payment for what they're doing. I just think Bitcoin changed it to an electronic, easier to flow type of currency. But I don't think the answer is regulating it outside of the KYC, AML, but not squashing it. I think the innovation is too important I think you have to go the bad guys. You know, the head of Silk Road, which is one of the organizations using Bitcoin, was caught. You know, and the FBI and others, I'm sure they have lots of ways of trying to, you know, do what they can and find the bad guys, but I think that's where you need to look. Look for the bad guys versus the killing the currency.
Yes.
This question is for Jim. You mentioned there's actually a lot of business model innovation going on under all these applications. How much of that is uniquely driven by the, say, blockchain technology, or can we have alternative ways of achieving them so that it's not so married to the technology per se?
Yeah, I think the marriage to technology is it's there, but I think it's not as strong as some people think it is. But look at the Bitcoin model. You can move money anywhere in the world in, well, it used to be 10 minutes. Now it's longer than that. But the technology just opened up people to think differently about how they move money. And with the blockchain, with distributed ledger, you can have access into information. You can have a shared ledger where that actually is the record. So from an accounting perspective, that adds value. So if you're doing less reconciliation in, say, a stock process, a post-trade process, you can actually look at a ledger that has a stock. It is the ledger that you can see that is the record that does add the value. So I think in some cases it is the ledger that causes these business models to change, especially when you have multiple parties. You know, we've had shared ledgers, we've had this technology for 30 years, all of this technology, but I think it really opened people up to the potential of thinking differently and being willing to use this technology in a different way. So I would say it's probably 70% of the value, if I had to pick a number, of why they're driving the business reason, why you're driving a business process change. It won't all happen, but I think a lot of it will.
Yes.
Bill? Well, I'll just say of any incumbent, I won't pick on SWIFT or anything like that, any incumbent that's a middleman, which the Fed is, stock exchanges are, SWIFT, clearinghouse, you know, we're all middlemen, and I wouldn't say that the fintechs are going to put us out of business anytime necessarily. I think what they will do is wake us up in some cases to be a little more innovative with some of our systems in a way that maybe we're pushed to be innovative in a way that's positive. I don't see the technology personally disrupting SWIFT. I may see it creating competition or making them be better, but I don't see the future of SWIFT going away. I think it only helps to add competition.
Second, Aaron.
Hi, this question is from Mr. Nelson. In your presentation, you said that you don't see people turning to the use of cryptocurrencies in the case of hyperinflation. However, in Venezuela, people are already doing that. They're adopting, they're building mining rigs for Bitcoin, for Ethereum in the face of hyperinflation there, so that they can purchase goods on the internet. I just wanted to know if you could speak to that.
That's interesting. I didn't know that. How does do you have any idea how the adoption of those cryptocurrencies compares to the adoption of dollar within the economy?
I'm not aware of that.
Okay. I mean, I wonder if it's material, then that would, I think, raise some questions about my conclusion.
I think one thing, if you look at the Cyprus banking crisis, that created, when they devalued the currency, that created a spike in Bitcoin. But it doesn't mean that Cyprus is turning into a cryptocurrency country. It just means that overnight or for a week or some period of time, they're hedging the inflation, and they'll all go back to some currency. So if it does happen, I don't see it as a systemic change to the way they transact. It's just a store of value that's available but not going to be held long.
Could be a way to get a dollar exposure, as opposed to a way to
So I see it as two different questions. It's not going to be adoption, more of a temporarily important storm.
Yeah.
All right, so this is a question for Jim. So I'm just trying to understand better about those private blockchains. So I can see all the innovations in those public blockchains like Bitcoin, but I'm trying to compare, for example, the private blockchains. How does it compare, just for example, to existing models? Even like think about Dropbox or like Git, like getting consensus, right? What can we see the major difference for those private blockchains versus those existing technologies? Thanks.
All right, so if you think about all the banks in the U.S. right now, they all interconnect through the clearinghouse of the Fed or through, correspondent types of relationships. But just think if they could actually, move money directly amongst themselves, the settlement coin or low value, and, they would be a closed network of all the banks and credit unions in the U.S. So the technology is being developed or has been developed for them to actually do that because it's a club. They want a closed network, but it's a lot of players. And so the technology is saying, the question then comes into, in that network, and this hasn't been answered, who are the equivalent of miners? Who does the validation of transactions? Is it the Fed or is it the clearinghouse? Is it the top 10 banks? So, that's still to be answered. When you have a closed network, how do you think about the mining and validation operation? And then someone is still having to set some rules. So how does that work? So, it's not the technology once again, because you can make that work. You can have public key, you can have redundancy and shared models that you can only see your own balance. That's the easy part. But how do you get all the banks to work together to create something where they're going to trust each other's tokens, if you will, for moving money? And if you look at, Quarter and any of the Hyperledger, most of the open applications now, chain protocol, they all can be built with a closed network with different mining options.
Let's see if there's any more question. I think we might have time for one more. Okay, with that, let's give our speakers a good hand.
Nice working with you.
All want to know that.
So Jim, that is the validating the token, then in the end, is it different from, like Fedwire or,
Well, the difference, and once again, I'm just really starting to get into this because I was a naysayer. Well, if the Fed is down, Bank of Europe can still send something to State without us being there. And they can, because we issue the coin, but we don't validate it. It's